The cheapest property that we have bought for a client was I think $320,000, and it literally just needed about 70K, deposit. A lot of people got a friend who might have invested somewhere, made money, but what you need to understand is that the growth is behind you. So just make sure that you don't follow the next hotspot, and make sure you're not overpaying for properties. There's a lot of property or street level due diligence that you need to do. Your property doesn't have transmission line close to the property, or you're not buying too close to train tracks, main busy highways. There's a lot of different, there's about 25 different things we look at when we are shortlisting properties for our clients. The property prices are going to go up, and if you target the right areas, the growth is much faster than the Australian average.
Which are the right areas?
So right now we're doing a lot of buying in.
Hi, I'm Priyanka and welcome to another episode of Level Up with Priyanka Shah. Have you got money sitting in your super account and you're wondering if it could be doing more for you? Or if you're thinking about buying property through a super account or a self-managed super fund and you don't know where to start or what's even possible? If that's on your mind, that's exactly what we're diving into today. We're joined by Arpit Shah, a very experienced buyer's advocate and the founder of Buyers Bud. And he has helped so many clients find the right properties through self-managed super fund and helped accelerate their retirement savings. So let's jump straight into it. Thank you so much for joining us.
Yes.
Today. I'm so excited to be talking about...
Happy to be here. Thanks for having me. Yes.
No, I think it's the $1 million question these days that, everybody is wanting to buy properties through self-managed super fund. Are you able to share why are more people?
Yeah, it's been really popular over the last sort of 3 or 4 years. Ever since the interest rates went up, a lot of people, exhausted their borrowing capacity in their personal names. And people who've seen the power of property investment or believe in property investment, they've started looking in different ways or different structures where they can continue to build property portfolio. And SMSF is a great structure. It doesn't impact your personal borrowing capacity. Yeah. So it's been really good. It's got a lot of tax benefits. I can just go on in terms of the benefits of investing in SMSF. But yeah, we've seen, SMSF property investments gain a lot of popularity since COVID, because we've seen property booms and people who've invested in property have got results. They just want to double down and, buy properties under different structure, whether that's trust structure, company structures or SMSF as well. Yeah.
Sure. Perfect. Thank you for sharing that. I'll definitely come more into specific examples of how you've helped people. But the big question that I had is, for example, I have money sitting in my industry super fund, Australian super right now. And the last I checked was I got a 9% return on it. Yeah. If I'm getting that sort of return, why should I consider investing in property? Yeah,
it's a very common question we get asked all the time. And the one word answer to this is leverage. So let's say, for example, you've got $300,000 sitting in your super. Let's say your industry super made 10%, that's 30% growth. Yep. But if you were to invest the same $300,000 into property, bank is going to lend you another loan. So let's say bank will give you another $700,000 loan. You go invest $1 million in property. Yeah. And even if that property grows by 7%, which is the Australian average, you made $70,000 gains. So compared to, 30,000, 70,000 is a lot better. And then compound growth comes into the picture as well. So that's the power of property investment. Essentially, you cash on cash return is also better with property investment. And obviously the type of investments, we tend to get double-digit growth in the first few years as well. So it beats the Australian average. So you get your kind of, properties doing the hard work for you. Right. It smashes kind of industry super any day of the week. Yeah.
Right. Okay. I think that really makes sense. It's more like a light bulb moment that, it's not just the money that I have, that I'll be getting more money that the bank's really lending. Correct. And I'm getting the growth on that without having to put much more from my own pocket.
Yeah. So the debt that you're taking on against that particular property, that is going down over the period of time. And with inflation, if you park your money into assets, those are only growing over the period of time. So that is the benefit of, parking your money into assets. And, when you're putting your money with the industry super, you've got no control over it. In the end, they're also going to invest into stocks and real estate. And, you may have 2 or 3 years where they're doing 9%, 10% return, and suddenly you'll have 1 year where they've done maybe negative or, very minimum 1, 2, 3% returns as well. So we've all seen that. So it can be a bit volatile. So same thing with the property, it doesn't always go up, but when you look at the long-term horizon, the debt that you've taken on, it's reducing over the period of time. The asset value goes up, and really it's for your retirement. So when your time comes, you get all your tax-free money back into your super. Yeah.
Okay. And I think borrowing through SMSF, we've done an episode on that with our broker, Arpit Shah. So if you have any questions on how to borrow through SMSF, please have a look at that. I will link the episode in the description below. Thank you, Arpit. Coming back to this, are there any specific types of investors who would benefit better through self-managed super fund? Because a lot of people are cautious of what if the properties go down? What if I lose my money? This is for my retirement.
Of course, look, everything is important. Structuring is important. Having a right strategy is important. Buying properties in the right location, buying the right type of asset is important as well. And then, if you do everything correctly, SMSF, can be a very powerful way to build wealth. Again, property investment or, the end goal that everybody's chasing is to have that passive income, financial freedom, and property is just a vehicle to get there. And for us, we do a lot of SMSF investment. Every third client or every third purchase that we do for clients is always SMSF investment. So it's been super popular. And it's for investors who have seen results through property investment, who believe in property investment. I think they should definitely go down this path, especially if you've got a decent super balance. Even if you've got we've had clients who bought properties with even $70,000-$80,000 in their super. So it's just really budget, budget wise we can target any budget really to buy properties. It's just, you need to know which markets you can target and, mitigate your risk. But generally speaking, if you've got 150K sitting in your super, I think it's more than enough to be going and looking at, property investment through your SMSF.
So 150 is kind of like a sweet.
That's what they say. But I think it's just it's another myth as well that you need, minimum 100K, 150K. A lot of people say it'll be worthwhile just because they're thinking, there's only 500K or 600K properties out there. But the cheapest property that we have bought for a client was, I think, $320,000, and it literally just needed about 70K, deposit. That's what we do. We buy in a lot of regional areas. So we do regional towns for SMSF property investment, but we mitigate our risk by targeting areas which has got diversified economy, that's got good, income, market, they've got good demand, not a lot of supply, more demand. So we look at all the fundamentals, and, if it checks the boxes, we like to invest in regional towns because your rental yields are also better. Now with SMSF, your interest rates would be higher than your, normal personal names. So we got to make sure that the investment that we're making is not too negative. We're not, it's not costing too much to hold the property as well. And that's the reason why, we like investing in regional areas quite a lot with SMSF property investments.
So you're investing in regional, is it more like, is there a rule even that it has to be a residential, or can it be commercial, or any guidelines around that?
Look, if you are just getting started, residential is much safer, bet because Australian real estate or Australian housing, it's as blue chip as it gets. You're talking about $13 trillion, market. People would need, homes to live in. Commercial can be a bit volatile. You could have longer vacancies, 6 months vacancies at sometimes. Also, it requires higher deposit as well. So you need bigger capital. Sometimes you need about 30 to 40% capital to get into commercial. So it's great if you're getting closer to your retirement, if you've got access to more capital and you're investing for passive income. It's really good because you get net yields, tenant space for the outgoing. So there's some benefits of commercial property investment. I myself own both residential and commercial investment. But for somebody who's getting started, if you're buying your first, second, third investment, you want to build some equity, and residential property investment are known to get more capital growth. So you accelerate your capital growth by investing into residential properties, and then eventually, you let that, properties double in value, or, as you get closer to your retirement, maybe diversify, sell those residential assets and convert into commercial, because by that time you maybe you've seen enough growth in your residential portfolio, and then you're more investing for passive income. So yeah, the commercial is good for somebody who wants that passive income or more yields. But even with the residential investment, there are different strategies. Like we can do house plus granny flat, duplexes, rooming houses, shared accommodation. There's a lot of different strategies where you can generate that additional cash flow through residential property investment as well.
Commercials more for the sophisticated investor who's kind of more experienced in this.
There's the different school of thoughts. There's people out there buying their first property as commercial as well. But generally speaking, you should start with the residential, build a sizable portfolio, and then switch to commercial would be the standard kind of suggestion that we would be making to our clients.
This episode is sponsored by Finsol Insurance, where we help families protect what matters most: your health, your loved ones, and your lifestyle. Life is unpredictable, but your financial security shouldn't be. So if you're a parent, a homeowner, or just someone who values peace of mind, make sure that you are protected with the right protection. Use the link below to book a strategy call and take the first step towards securing your future. The big question is coming to the growth. Like, again, of course, we understand that growth can be very variable, different for different. Like, are you able to share a good case scenario that, if you've had someone who invested their super in a property, what sort of growth you got? And
yeah, sure. So we've got a very unique strategy. If somebody, let's say, came to us, said, we've got 350K sitting our super, we would rather suggest them to diversify into 2 property investments. By doing this, they're mitigating their risk, because generally we would diversify into different locations. So we're buying 2 properties in 2 different locations. We're maximizing, or cash flow generally tends to be better if the properties are affordable. As you start to go, over 800-900K, $1 million, capital city, you're with traditional property investment, you're very negative. So in your super, it's costing you a lot of money, or, what your employer contributions are being made. It's getting chewed up, but just to hold the property. So instead, we are always suggesting our clients to diversify investment. So we had our client, one of our early clients, when we started the business, Neeraj. So Neeraj is in Melbourne. He's a single dad. He had about 350K, pretty good super balance. And he used to constantly, do salary sacrifice and, contribute more and more into his super. So we formed a strategy. It was like, okay, we're going to go and buy 2 property investment. So first one, we targeted in Queensland. So we bought in Townsville for about 350K. And that investment has done incredibly well. There was a time, I think Townsville did about 25-30% growth in 1 year itself. So over the 2 years, I think he's made over 50-60% growth in his property investment, right? So if you talk about, so that was the first investment. So that was 350K. Second investment we did in Perth, so WA. So again, Neeraj based in Melbourne, bought 1 property in Queensland, 1 in Western Australia. Western Australia property, I think at that time it was like 460K. That was a 4-bed, 2-bath. Both, properties, good block size, good fundamentals, vacancy rate tight. So both got rented quickly. And, both grew in value about 50-60% over the 2 years period. And what that did was essentially, so if you talk about the cash on cash return, is sitting at about, out of the 350,000 he would have, invested into the properties as a deposit, he's got more than that back, in terms of the equity. Now you can't refinance, but like, for example, if somebody's got 2 property investment, they can always, sell one and pay off the debt of the other one. And that's the reason why we like this strategy where, instead of buying one big, putting all the capitals towards one asset, let's go diversify and put it into 2 different investments.
And that's a great strategy, because that would mean that the loan would not be that long term.
Correct.
Either. So
Exactly. So let's say you hold on to both the properties for 5 years, and again, every market performs a bit differently. So if you had one property that grew significantly, then you can essentially look to sell that investments. Again, capital gains tax is very minimum, even less than 10% in your self-managed super fund, which is amazing, so that you get all the profits back, and then essentially eventually you can pay off the debt of the other property, and then what you have is net passive income. So yeah, that's what we like to do, and that's what I'm doing as well. I've got 2 properties in my SMSF. I've got one as a long-term hold, and the other one, it's kind of hold it for the short term. If you see good amount of growth, you sell that property and accelerate your capital. So so for example, if my property grew in value by $150,000, if I'm getting that back into my super, you just relying on my super contribution, it will take me about 4 to 5 years to save up that much money. But property can do that within 1.5 year as well. So that's the power
That
of.
sounds great, but it also sounds a bit complex. Like, how would you manage properties in different states if you're sitting here?
Yeah.
And is that something that you help with, or?
Yeah, we always have like local property managers. So we always based. So wherever we're buying properties, we have our network on the ground. So these are associates or property managers. Generally speaking, property managers, we like to hire somebody who's local, who is familiar with that area, who understands the market, understands the demographics and the type of tenants that they're going to attract. We want to make sure these properties that we buy are not remaining vacant. So while we're looking at the data, we also rely on local knowledge. So we want to make sure that the tenants that we are putting in are good. They're vetted properly. They've got their references checks done. They've got their income verification done, that they're able to afford the rent. And yeah, it's like that mitigates our risk. So we don't need to go and physically drive past our property, or we don't need to actively manage. If you've got a good property manager, they can look after the property, and they generally experts and licensed in that area. So yeah, we leave it up to the experts to manage the property in terms of any maintenance it may require, to collect rent, and if something needs to be escalated, they know what channels they can take, whether we need to go to VCAT or anything like that. Yeah.
Okay, I think that's awesome. Maybe I'll actually recap again on why would someone need a buyer's advocate versus trying to invest in property? Like, can you just maybe highlight the pros?
Yeah, I think, look, I mean, there's a lot of different reasons, but like if you know how to, if you understand your goals, and if you know how to form a strategy, if you know how to shortlist and research locations and identify the next growth market, if you know how to do proper due diligence on a property, if you know how to negotiate, if you know the end-to-end process of what it requires to do a property transaction, then you don't need a buyer's agent. But that is where, we come in, we handhold, and we provide our support to our clients, from the strategy to execution. And, a lot of, clients approach us. Some might have, already got some knowledge in terms of they might be familiar with certain areas, or they might have invested in properties. But it's a different ball game, because now there's a lot of, borderless investors. So we're not limited to just investing in, Melbourne or Victoria. If you're in Victoria, look, generally we like to diversify investment. Like my own portfolio is spread across 5 states, and that's what we do for our clients as well. Like we truly see the power of, when you're mitigating risk and diversifying your investments, you start to see kind of your overall portfolio growth. So let's say if one location grows in value, but the other one is quiet, your portfolio is still moving, at the end of the day. That's what we want to see. So that's where, buyer agents add value, is because, we form the right strategy. We help identify the right location to buy property in. We mitigate risk in terms of, doing the proper due diligence, make sure we're not buying property that falls under flood zone, bushfire zone, housing commission, traffic. We want to make sure that the asset that we're buying has got X factor associated to it, that in future when we are looking to sell that property, that it will attract to the mass market as well.
Absolutely. And I think there is a lot of expert knowledge that's going behind, especially like if I would say that I have multiple property investments, but it's either in areas that I know more about, it's in the same city or the same state, but I know when I have to diversify into other places and regions, I would have no clue about it. And I think that's where definitely I would learn.
100%. Like, where to buy, how to buy, what to buy, so we try and cover all these questions, and we're very big on the why, so if you're recommending a location or why we should invest there, we back it by data. So there's no guesswork, there's no, following the herd sort of mentality. Often we are challenging and we're having healthy discussion with our clients in terms of why we should target this particular location. Again, we're not biased towards one particular state or one particular market. market. At the end of the day, we will go where the data is pointing. And so we're very big on why we should invest in a particular location, why we should buy a particular type of property. I think it's really important to educate the client so that they build their knowledge and they build their confidence. It's super important that they feel supported throughout that journey, because it can be overwhelming, and majority of our clients are people who don't have a lot of opportunities, or in terms of they don't have they don't want to be making mistakes because they've all got limited borrowing capacity. So at the end of the day, if you've got let's say, for example, you do one or two investments, I mean, if you do that right, if you create a strong solid foundation, then you can build upon it. And because those properties will give you enough equity and confidence in return so that you can build upon that.
And especially because when people are investing through their super money, that's like their safety net anyway.
Correct.
And kind of playing there's a bit of nervousness, but when you're in the right hands, it takes care of a lot of things.
Absolutely. And property investment is probably the safe bet, but I've come across people who are using their super money. They think, super is, I'm only going to access that money when I retire. So they're open to taking more risk with it. So they're investing in crypto, they're investing in stocks, they're doing more active stuff with it. Again, we are more about, passive investments. We are more about, let the long term, or time in the market do its thing. And that's where property investments are really good, because it doesn't require you to, go check your portfolio every day. You just leave it, and you 100% it will grow in value. And, properties are generally, 7 to 10 years, it should double in value, if you buy the right type of properties. In the long term, it's just one of those things where, if you do kind of 1, 2, 3, and if they produce results, then the game is addictive, so then you want to go again and again.
And I think if you're not doing property and you're doing something else, you probably miss out on that leverage that we spoke about.
100%. So banks are not as easy, they wouldn't lend you money for other asset class, so it's property. That's why it's considered blue chip, for a reason. And then generally, nowadays there are lenders who willing to give you loan for even 10% deposit. So there's even for self-managed super fund. So it just really depends on what your goals are and what you want to achieve. And if you start planning 30 years ahead, 20 years ahead, 10 years ahead to retirement, the earlier you start, the better sort of long-term compound growth you will see as well.
Sure. Sounds good. Thank you for sharing that. Arpit, can you really buy property through your super fund?
Yeah, absolutely. You can. Doesn't matter even if you've exhausted your borrowing capacity. SMSF, borrowing capacity is separate to your personal names. So it generally depends on, how much super balance have you got accumulated. So we're talking about combined super balance. So husband and wife combined super balance that you can use as a deposit. And then whatever your employer, super contribution, or if you're self-employed, how much you're contributing to your super. Based on that one, bank will be willing to give you a loan. So if you speak to a good broker, you can understand in terms of what is your servicing, how much can you borrow, and then based on your deposit, you can really form a budget of, what sort of properties can you target.
Okay, perfect. Thank you for sharing that. What is the biggest advantage of investing into property through self-managed super fund versus leaving it in the super fund?
So I think, as I said, one word answer is leverage. So with a property investment in SMSF, if you've got 200K, 300K leave, in your super might be giving you 10% return, but property can, give you maybe 30% return cash on cash. Why? Because, against your 200K, bank can lend you another 400K. You've got 600K invested in the market. And then, you can, even if your property grows by, 42K, you are going to see much better growth, but also it's producing some rental income as well, against that. So if you factor both those things in, your property is out smashing your industry super any day of the week.
That's very exciting. I'll definitely do that. But what is one common misconception that you see when people come to you when they want to invest in property using their super money?
I think a lot of people, think it's really complicated, or there's a lot of risk associated with it. And some people, they think about it and they put it on the back burner, thinking, there's too much admin, or I might have to get my insurance sorted myself, or it's just it's a daunting feeling to some people. people when they think, oh, I need to take control of the funds. But in a way, like it's not that complicated. Once you do it, it's and you get the right professionals, to support you through that. You get a good financial planner, you get a good accountant, mortgage broker, buyer's agent, insurance advisor, and then you've got it covered. Essentially, people can handhold and support you through that, navigate you through that process. And there's answers for every question, but you just gotta take that first step, and sometimes you just gotta do it, and then you'll see the results. At the end of the day, when you see the results, that's when you start to believe in the process as well. But sometimes you got to take that leap of faith.
And it's about kind of trusting the right people as well, and
Exactly.
not assuming things. So
Absolutely. I think it's very common. People are sometimes very comfortable in their their life, their family, their situation. They're like, oh, we've got an income coming in, and they're putting 10%, 11% into the super contributions. It's going to grow over a period of time. It's retirement. I don't need to worry about that. But then as they get closer to the retirement, your super balance is not going to be enough. For most Australians, it's not going to be enough. So until and unless you take control of that super, and if you start planning to grow that super balance, it's not going to automatically happen. And no industry super is going to work as hard for you as yourself. Like at the end of the day, you're the one who should care more about your kind of retirement funds, or your money. Like nobody else cares about your money more than you do. So that's why I think everybody should look into SMSF, do some research, get some knowledge, speak to the right professional, develop your understanding, your knowledge, and then gain confidence accordingly as well.
Because complacency is not the answer. And what kind of returns can people realistically expect when they are investing?
Look, I mean, our rule is pretty simple. With SMSF or non-SMSF, the type of properties that we like to buy, we want to see double-digit growth, early on, because we feel that if you see that growth early on, then you've got compound growth coming into the picture, which is much faster as well. So let's say, for example, we invested in an area which grew by 10%, 15%, let's say, in the first year. Then essentially, even if the growth drops to maybe 7 or 8%, it's basically the 115% growth, which is now growing by 7 or 8%. So your compound growth tends to be much bigger. It just generally, develops more confidence for an investor as well. As much as possible, we want to see that, faster growth. But obviously, there's horses for courses. So it really depends on how much capital you're starting with, what strategy do we form for you. So realistically, double-digit growth is what we see.
Is realistic.
Realistic, very realistic, with the way the property market has been and is going to be, with the way interest rates coming down, and your 5% schemes, and the government, and it's just overall there's not enough supply and there's more demand for housing. So that's just going to mean one thing, that the property prices are going to go up, and if you target the right areas, the growth is much faster than the Australian average.
Which are the right areas? Any
so right now we're doing a lot of buying in regional Victoria, regional New South Wales, and Tasmania. These are the next 3 growth markets. If I talk about a sort of 1-2 years ago, the story was a lot of investments were happening in Queensland and Western Australia. Now these areas have grown in value, we're seeing a lot of Melbourne as well. Even we bought in SMSF properties as well as we do a lot of personal investments in Melbourne. Melbourne has got a lot of under market value properties at the moment, because comparatively your Brisbane's and Perth's and Adelaide's have grown too much in the last sort of 4 or 5 years. We're seeing a lot of value in Melbourne, and a lot of investor interest across the country who are looking at Melbourne and want to park that investment into a capital city. So Melbourne is good. Regional Victoria, there's about 4 or 5 different regions where we're investing in. Regional New South Wales is good, and regional Tasmania is good as well, from that perspective. We're talking about sort of that $500, $600, $700,000 investments, which is balancing capital growth with cash flow at the same time.
Wow, that's good to know. And if for someone who's wanting to invest in property and trying to do it all on their own,
Yeah.
are there any red flags that they should be aware of and avoid?
Yeah, I guess first thing is like, make sure you're not investing in a market which is already in media, already kind of overinflated. A lot of people, got a friend who might have invested somewhere, made money. But what you need to understand is that the growth is behind you.
already too
Yeah,
late
so
for
it's
that.
already might be too late. So just make sure that, you don't follow the next hotspot, and, make sure you're not overpaying for properties, and make sure the fundamentals stacks up as well. That make sure that, if you're getting into a market, understand what your goals, what your strategy are with that particular investment. How long, do you want to wait to get the equity out as well? Sometimes, you're investing for short-term growth, medium-term, long-term growth. So understanding that strategy is really important. Buying in the right location is really important at the right time. But also there's a lot of, property or street level due diligence that you need to do. Make sure, your property doesn't have, a transmission line close to the property, or you're not buying too close to train tracks, main busy highways. There's a lot of different, there's about 25 different things we look at when we are shortlisting properties for our clients. So just make sure you do your due diligence, make sure you understand what you're getting into, because buying property can be an expensive mistake, because, most people have got limited borrowing capacity. So you don't want to get stuck with an investment for 5 years. It comes with a lot of opportunity costs, which is one thing that people, tend to ignore, that they'll just be like, oh, I just buy property anywhere, I just hold on to it for long term. But what they don't understand is it comes with an opportunity cost. The next 5 years, if your property doesn't grow in value, there is that, X factor, that X amount of growth that you could have had with if that property was elsewhere, in the right location. So that's how we explain, to our clients, when we are proposing which areas we should target or what type of properties we should buy.
Sure.
Yeah.
Great. Thanks for sharing that. And lastly, if I had to ask you if you could summarize investing in property through their super in one word, what would that be?
Yeah, I just get like any property investment, but even like more in SMSF, it's leverage. The other towards tax benefit, retirement, wealth creation. There's a lot of benefits. Yeah, I think everyone should look into it if you haven't done that already, and if you are looking into it, look into this strategy of if you can split that one big investment into two separate investments. I think that can be game changer for a lot of people. So one could be your passive, long-term investment. One could be a bit active, where you holding on to 1, 2, 3 years and then selling and, extracting some capital out of that as well. And really accelerating, your, the wealth that you have in your, super, so that you have more money for your retirement as well. Yeah.
Great. Thank you so much for sharing that and those wonderful insights. They've been so informative, Arpit. Thank you so much.
Thank you so much. I was really enjoyed this session. Thanks, Priyanka. Thanks for having me.
Thank you very much.
Cheers.